the recording and we'll get started. All right, thank you everyone for joining us for the free lunch webinar series, Farmland Leasing. We're grateful to have Dr. Chris Clark from UTAA joining us as today's instructor along with me. So a few housekeeping items before we get started. Please leave your microphones on mute and video off during the session. And if you like to locate the chat box right now, please type your name and location into the box to help me record attendance. And you can use the chat box at any time to submit your question. I am recording the session and plan to post it online in case you like to share it with someone else. And I like to ask you 2 questions at the end of the session to record feedbacks. All right, so without questions so far, let's jump into today's session. So these 3 webinar series, this webinar series contains 3 little short sessions. Each session lasts about half an hour. So the first topic, we're going to talk about types and terms. And the second one, we're going to go into how to figure out a fair rental rate. And last session, Dr. Clark will talk about legal considerations. All right, so before we get started, I'd like to know if you're a landlord or a tenant. So just put in the chat box L or T to let us know if whether you're a landlord or tenant, or you could be both. Okay, we're seeing a lot of landlords. And the reason I ask that is because from landlord or the tenant, the points of view will be different. But hopefully with this 3 sessions, with the information we're teaching you, that you're able to figure out what is fair for both of you and reach a good and fair agreement. So today we're going to talk about different types of farmland leases and which one is right for you. Do I need to have a written lease, or is an oral lease sufficient? And what should my lease say? So there are 3 types of farmland leases, and the types depends on how the rent is paid. So the first is cash leases, and that includes fixed cash leases and flexible cash leases. And the second type is share leases. And the third type is a hybrid between the 2. We're going to jump into the cash leases. Fixed cash leases. So like I said, the rent is predetermined or fixed by the lease agreement. So tenant makes production and marketing decisions, and the tenant bears all the production and price risk. And the owner or the landlord will have a fixed income going into the production year. So the flexible cash leases, like I said, is not fixed anymore. So your income will not be fixed, and it will be tied to yield or gain, or crop, livestock prices, or tied to input costs. So tenants will most likely to make the most production or marketing decisions, where the landlord and tenant share production and price risk. And as you can tell, that could directs into future conflicts, but it all depends on the transparency and the trust between the landlord and then the tenant, and the record keeping and the sharing of information is going to be very crucial for this type of leases. I'm going to use examples to illustrate every type of the leasing. So using an orchard lease agreement as example, one option is to have an annual fixed rate or amount is paid by the lessee to the landlord on or before specific dates. For example, the tenant pays the landlord $150 per acre of bearing fruit on or before January 10th, immediately following that crop year. So you can see that $150 per acre is fixed no matter what happened to a yield or happened to the price. So the second lease type is share leases. So the rent is a specific share or percentage of the crop or livestock produced. And the landowner and tenant share production and marketing decisions, expenses associated with the operation, and production price risk. Using that same orchard example, there's another option B. If chosen, the subject crop income is allocated by a defined percentage of each payment received by the lessor to the landlord. So, for example, the tenant will retain the 85% of the crop income, whereas the landowner or landlord will receive the 15% of each payment. An alternative frequently allows the lessee to hold the landlord's share until a specific date. And there are 2 points I pointed out here is the record keeping is going to be crucial. Like I already mentioned that the transparency of record keeping is going to be crucial between the landlord and the tenant because this type of crop share or share agreement will require the landlord to also know how much payments you're receiving. So records of all expenses yields will be kept by the tenant and shall be available to landlord upon request. And also point out the USDA farm program payments. It's also type of payments. A lot of farmers receive actually quite a large percent of their income coming from the farm program payments last year. So it needs to be specifically included in this type of agreement, like how it will be shared in the following manner. So the last leasing type is a hybrid lease. So it's a combination of the cash and the percentage or the share of the two I just mentioned to you. And one example I like to use is greenhouse leases. So if you're renting your greenhouse to someone else, a base rent could be predetermined by square footage. For example, a fixed rent at 10 cents or 20 cents per square foot, and then plus whatever above that certain crop sales or certain uh, gross sales threshold, and then you charge possibly 50-50 between the landowner and the tenant. So that's a combination of the two above certain threshold that you both agree upon, and then how is that return divided? So the landowner and the tenant share production and price risk. Because as you can tell, if the tenant do well in their sales, the landlord will receive a larger share as well, instead of just the fixed amount. So using the same example, orchard, the option A is pricing option is designed to reimburse the lessee their operating expenses first, and the residue return thereafter are typically shared between the lessor and the lessee. So in this case, the tenant receives the first 40 cents per pound or the first $1,100 per bearing acre of cherries, whereas the lessee and the lessor then each receive 50% of the remaining return or remaining income as it is received per acre, per bushel, or per ton. So we talked about so far what are the types. Now let's turn to Dr. Clark for how to choose a leasing type.
Thank you, Iris. Can you hear me good? Okay.
Mhm.
All right. Um, so the first place really to start in thinking about, which of these different types of leases to consider, I would argue are what economists would call transactions cost, right? How much is it going to cost you to enter into this transaction, this agreement? And what you're really doing is you're weighing the reduced cost of a simple leasing arrangement against the potential benefits and higher costs of a more complex arrangement. And so I think one of the important questions you're going to ask in regard to this is, how important is the amount of the rental payments to me? How important is it to the landlord and tenant? The more important those payments are, the more likely that you're going to find that the benefits of a more complex arrangement outweigh the cost. Um, the second factor, um, Iris has talked about, it's really the sharing of production and price risk. When we talk about risk, I really mean both upside risk and downside risk. And so it's the potential for earning a higher rate of return as a landowner than you would under a fixed cash lease, for example, in addition to the possibility from the producer side of having some protection against a bad year. And so, leasing can in and of itself be a risk management tool for. I haven't talked to anybody in a while. Um, Sorry, so I'm just getting the process back. So leasing can in and of itself be a risk management tool for producers. Now, how valuable of a tool it is will likely depend upon how the lease is structured. Uh, Thus, those who are in a better position to bear risk, be it landlord or tenant, is a key question to ask when you're choosing a lease type. So, just as an example, if you're a landowner who's on a fixed income who is counting on these lease payments to cover some monthly expenses, for example, then you're not in a very good position to bear much risk, right? And the certainty and the fixed nature of rent becomes very important to you. On the other hand, if you're a landowner who has more assets or a more diverse, income stream, then you may be looking for ways to increase your rate of return. And so you may be interested in sharing some of that risk with your tenant in exchange for receiving what is on, in average terms, a higher return. Um, Similarly, from the producer side, if you're a new and beginning producer, you may not be in a position to bear a lot of risk. And so you may be willing to trade some income in good years for some protection in down years. And that's really what we try to do with these different lease types is balance these production and price risks between the two parties. Third factor would be the involvement of the landowner in the operation of the farming enterprise. So certainly landowners are going to have to give up some control of what happens on their land when they lease that land to somebody else. Now, exactly how much control they're going to give up is going to vary depending upon both the type of lease you enter into and the terms of that lease agreement. Um, Lastly, there are potential tax and accounting issues that could affect how you want the lease structured. We're really not going to go into these. They're going to be very specific to your situation. So what I'm going to sort of default here and just recommend you always consult with your tax preparer or accountant to understand any tax or social security implications of a lease. Okay. So now moving to think through the specific types of leases. And so starting with cash leases. A key advantage of cash leases is that they're the simplest type of lease. And so again, if you're trying to minimize these transactions costs, you're going to go with a cash lease. Um, they also typically limit the landowner's participation in the operation of the farming enterprise. Whether that's a good thing or a bad thing is going to depend upon whether that participation would be valuable or productive or whether it would not. Um, and so, in particular, fixed cash leases are the far and away the simplest form of farmland lease. Since the amount of rent is certain and fixed at the time the lease is signed, then these leases are going to be more appropriate where the tenant is in a better position than the landowner to bear the production and price risk. Um, Fixed cash leases also ensure that the party responsible for management and marketing decisions, i.e., the tenant, bears all of that production and price risk. Finally, fixed cash leases may not be suitable for landowners or tenants interested in a multiple year lease due to the uncertainty over future yields and prices. This could be anything from inflation, right? So if it's when you look at commercial enterprises, for example, that enter into to long-term lease, 10, 20, 30 years, there's always going to be some adjustment built in there to control for inflation. But you may also want to build in some sort of adjustment to account for the fact that you can have, in the agriculture context, pretty dramatic changes, swings in crop, output prices, commodity prices, for example. Um, all right, and so the second type here is a flexible cash lease. So flexible cash leases are a little bit more complex than fixed cash leases because you're going to have to agree. You're not agreeing on a specific rental amount. You're agreeing on a way to determine, right, a formula essentially for determining a specific rent amount. And so there are going to be some increased record keeping and reporting requirements. On the other hand, they do allow then the landowner and tenant to share this production and price risk in whatever way makes the most sense for them. And there are all sorts of different ways that you can do this. And there are also really good examples out there to follow. At the end of this session today, Iris is going to talk a little bit about some other resources. It's not hard to find plenty of examples of flexible cash lease structures. So from the legal perspective, it's really not that difficult. I mean, it's a little bit, yes, it is a little bit more complex, but it's not hard to do at all from a legal perspective. Really where that extra complexity or that burden is it's going to require a little bit more knowledge and or information sharing between landlord and tenant in terms of what yields are going to what yields are important, or what yield levels are important or likely, and or prices. So there's going to be a little bit more sophistication, I guess, in terms of specifying those things in the lease agreement. Okay, so third type of lease agreement are share leases. Share leases, now we're starting to step up in terms of complexity because it's going to be a more involved, complex relationship between landlord and tenant, and thus it's going to be a more complex lease agreement. Uh, Crop share leases are going to be more likely to be appropriate for tenants who either cannot supply all the operating capital or who might be in a position where they would benefit from the landowner's knowledge of the farm and or the farming operation, or the landowner's management and marketing expertise. Excuse me. Um, and so, beginning farmers, for example, a share lease might make a lot of sense. Uh, Potential disadvantage of share leases is that they can increase the potential for friction between landowner and tenant over these production and marketing decisions. You are going to have more landowner involvement. Again, that can be a good or a bad thing. They're also going to require more detailed record keeping, because now it's going to matter, what all these input costs were because you're sharing those, and what the revenues are. In a fixed cash lease, it doesn't matter from the landlord's perspective, right? The tenant's liable for a certain amount of rent regardless of what happens on the enterprise. Um, so for all those reasons, a bit more effort is involved in structuring a share agreement. Where share agreements have been common, a lot of times you have sort of standard allocation, standard percentages. And so landlords and tenants may feel comfortable trusting those standard percentages. And so it may not be that difficult to specify those because you can just rely on what's sort of been done in the past. A little bit, got to be a little bit careful with that because obviously conditions change. And um, just because it were commonly used doesn't mean that those allocations fit every circumstance. And so one size fits all may not be always the best solution. All right. So now it's sort of soapbox time. Iris motivated the session with one of the questions being of should I have a written lease or is an oral lease sufficient? And I'm going to argue that you always want to have a written lease. So oral leases in Tennessee are valid and enforceable as long as they do not extend for more than 1 year. So oral leases that are for a year or less are valid and enforceable. But oral leases that extend for more than a year are not. They're invalid under something known as the statute of frauds. And by virtue of the statute of frauds, any contract that can't be completed within 1 year in any agreement for the sale of real property has to be in writing to be enforceable. So, written leases are recommended. Why? I would argue that they help prevent disputes by limiting the potential for misunderstandings. They provide the terms of the agreement in case either party dies or becomes incapacitated. They can provide documentation for tax purposes. And to my mind, the most important advantage of a written lease is it really allows for a fuller specification, a more complete agreement of the arrangement. When you have a written lease, you can sit down, you can talk about, you can think about all these contingencies and these possibilities that you're not going to do in an oral leasing situation. And by doing so, hopefully you're going to avoid some future, potential for future conflict. Um, so, in terms of oral leases, then I would argue that all leases, excuse me, written or oral leases, all leases should provide obviously the names and addresses of the landowner tenant and a reasonably accurate description of the land and or the buildings to be leased. Legal descriptions are preferred, but they're not required. Really, the key is to make it clear to potentially a court exactly what land is being leased. If it's only part of a farm, then you can use maps, some sort of graphic to illustrate what it is. Doesn't have to be just language, doesn't have to be just text. Uh, all leases should also specify the rental rate. Next slide. Iris. All leases should specify the rental rate or the procedure for calculating that rate and designate the time and place the rent is to be paid. As a landlord, you're often going to want to include some sort of penalty for late payment of rent. Uh, Certainly, all leases should specify the time period over which they are to extend. That's probably one of the topics we'll talk about in I guess session 3 is what happens if you have an oral lease and what that means in terms of expiration and termination. Uh, Most farm leases are for a period of 1 to 5 years. Yeah. And finally, all leases, of course, should be signed and dated by both parties. They do not need to be um, Sean a blank, not witnessed, uh, notarized. They don't need to be notarized unless they're going to be recorded. There are times when you might choose to record a lease, but typically you don't have to. Um, all pasture leases, so the next slide, should also, you want to specify a maximum stocking rate as a landowner, right? I talked earlier about that landowners are going to have to give up some control. There are certain provisions you can include in a lease to retain some of that control. And this is a good example that you may have a use clause or a series of use clauses in the lease that specify what your tenant can and cannot do on your land. And again, a good example of something you would have in a written agreement that you might not cover fully in an oral agreement. If water is going to be an issue in terms of the livestock in a pasture lease, then certainly that should be specified. It's a situation where you want to avoid assumptions. Each party come into their own assumptions about how something's going to be handled. Um, let's see. Next one. All share leases should specify, obviously, the share production costs to be paid by each party. They should impose record keeping requirements on both the parties. Typically, tenants are going to be responsible for record keeping as they're generally closer to the day-to-day farm operations. Not always. Sometimes you see landowners being required to keep direct books. Uh, Finally, all share leases should explicitly provide that the parties do not. Oh, I skipped one. Landowners interested in government program payments should require tenants to keep and share productions, even in a cash lease. Yeah. Um, and so finally, all share leases should explicitly provide that the parties do not intend to operate as a partnership or joint venture, because those share agreements look a little bit like a partnership, and that's not the way you would want that arrangement construed. Okay, so I think Iris, it's back to you now.
Well, we're going through it pretty good. Well, just to summarize it, there are a lot of information I know packed in this video, but you can always come back to watch the recordings online. I send you the link in the email, and the presentation will be also included in the future email. So one of the resources I actually shared with someone in the past and I got really good feedback is a tool that developed by USDA. So it's a free step-by-step leasing tool. So you don't know where to get started with your leasing. This tool just simply asks the address, your name, and those type of things to fill the blanks. And then we'll give you a starting point to possibly print it out, to go to possibly attorney you work with or tax accountant to let them look at what are some other areas that need to be included. But just for building that basic leasing, a basic lease agreement, this is a really good tool that I recommend you to check it out. And then with UTIA, we also have a lot of leasing resources, publications in terms of what different types need to include what type, really specific, detailed information, what need to be included in crop share leasing, pasture leasing, and we also have sample leases for you to review. And those are achievable, or those are available on the website listed above in this slide. So that's really what we have for the first session. I know we go through it really quick, and we'll talk about how to set a rental rate um, next session. So let's see if we have any questions, and type your question in the chat box if you have them, and we'll have Dr. Clark answer those. Okay, Donna asked, may I have a copy of PowerPoint? Yes, I'll be able to share that with everybody. And someone is missing his audio, don't worry about it. We'll have the video available online for you to review at a later date. And I'm sorry that that happened to you. Um, can you place the website back up for the lease agreements? Sure, let me do that. Okay, we have a question, Dr. Clark. Someone has approached us for a 10-year lease. Is a lease that long ever advisable?
Um, Certainly, um, eh, if that's in your interest, right? It's common. Again, maybe not in the agricultural context, but in other contexts, obviously, it's very common to have leases that go for much longer than 10 years. Um, I think you have to, the question really becomes a couple of things. Well, now, yeah, there's the kicker right there at $50 per acre. Um, the things that you have to ask yourself is it okay to tie the land up for that long? Are you comfortable with that? If the answer to that's no, then the rest of what we talk about probably isn't going to matter. But if that's something that you think is desirable, then I think you have to think about what are the terms, and I'm going to sort of rephrase your question of, okay, if we decided we want to do this, how would we structure this? And that's where I would say that you want to make sure you're going to build in a mechanism into the lease so that you can keep that rental rate fair. Um, in the commercial world, a lot of times those adjustments. So a lot of times you're going to have a cash rent that's going to be tied to a measure of inflation. So there's the consumer price index, the CPI, and a lot of commercial leases you'll set a base rent for, say, if it was a 10-year lease, maybe the first 3 years will be at X, and then it will adjust every year or every 3 years based upon this inflation index. So as prices of everything goes up, then the rent will go up. Agricultural context, you probably are going to want to. I mean, it's a little bit again, it's a little bit more variable, and so you're probably going to tie it to something else, maybe crop prices. There's nothing wrong with the 10-year lease. The key will be, as a landowner, how do you build in a mechanism? How do you structure the lease, the rental payments, so that it's going to be as valuable to you in 10 years as it is today? Very interested in more information about keeping your own farm work documented as separate from the renter's work on the same farm. As you mentioned, if one is applying for federal grants, will there be more of that in future sessions? Uh, yes, I'll tell you what, and Kim, what I might ask you is to elaborate exactly what you're looking for in the email, and we'll try to get that into the next two. in one or the other of the next two sessions, um, because I'm not sure on the federal grants aspect. But anyway, you can our Iris has the on the slides. I think has both our emails, and so you can email either one of us with that. Okay. So back Donna, this land hasn't been farmed in years. We'd like to farm organically. Do you have contracts for partners who would work with us on that basis? Um, and so you're there. Use of the term partner is a little bit it's clouding things. Um, I suspect I don't think you're asking about going into a partnership, right? You can structure this arrangement as a partnership, either a general partnership or a limited partnership, and there are very specific sorts of implications of what that is. Um, on the other hand, it may be, for example, that you want to farm this in a share leasing situation where, again, they're not technically legally, they don't fit as partners, but they're just your share tenants. Um, and certainly, again, from a legal perspective, you can do either one of those things. Not hard. It's talking with is understanding the ramifications of that choice and thinking through what makes sense for both parties. Um, and the key difference there, partnership is a much more involved process. I mean, you really are you're partners, right? You're mutually going to be making decisions. You're mutually going to own the operation. You are mutually going to be liable for what happens. That's different under a share lease, right? The tenant typically is going to retain a lot more of the ownership and guidance there. Yes, I don't have an example in my files off the top of my head of an organic share lease, but I'm certain that they're out there. So it wouldn't be hard. And that's one of the things that Iris and I can look for. Um, I've never seen one, but I'd be shocked if if there aren't examples. Iris, you have questions you're posing for everybody?
We have another question from Lena Beth. Is there anything extra to consider when renting for corn silage to be used on a dairy? They're not selling corn for grain.
Um, so if you are, right. So obviously, Lena, Beth, I told Iris not to let you ask any questions. If if you're going a fixed cash lease, then no, right? You don't really care. Now, if it's a flexible cash lease, then how you flex that rent, then obviously you in that situation, if they were growing corn for grain, then looking at output, commodity, the price of corn on the open market is a logical way to try to do that. Here, you're not going to have that because that corn is going as an input into another process. And so there's not going to be a market price for that corn. So that's going to make it a little bit more difficult. Probably what you would think about there is looking at yield, right? And so you might adjust that rent based upon yield. Now, that's not going to help you if you're talking about a multiple year lease where you're thinking about inflation or you're thinking about the price of inputs and outputs changing over time. So that might be a little bit more challenging to think about how you're going to adjust that. It's not necessarily, I wouldn't say more challenging. It's going to be a little non-standard in terms of how you're going to adjust that rent over time if it is a multiple year lease.
Okay, great. Thanks, Doug Clark. I don't see any questions so far. And if you have other questions, feel free to type your question in the chat box. If not, thank you for joining us for the first session. It seemed like it just went by so fast. I thought it was a great idea to have a half an hour um, presentations for you all. But next time, hopefully everyone will join us again next Thursday at the same time. We'll learn about how to figure out a fair rental rate. And that session could be last a little bit longer than 30 minutes, but we will use examples to illustrate how to set a fair rent for the landlord and the tenant. So if you're willing to answer the two questions on your screen right now to help me record feedbacks, that's all for the day. Thank you all. Okay, we got another question. I was confused on the time. Will it be noon next week? Yes, noon Central. If you're in Eastern time zone, that'll be 1 p.m. But Central time, noon. Yes. All right. Thank you all. Have a good day.
Thank you. See you next week.
See ya.